Boa tarde, good afternoon everyone. I'm Daniel Guevara, portfolio manager here at Wealth High Governance. I want to welcome to our investment book club. This is a special edition. Together with Tony Volpon, our chief strategy, we are honored to host Marko Papic. Marko is a partner and chief strategist at Clocktower Group, an alternative investment asset management firm based in Santa Monica, California. He leads the firm's strategy team, providing bespoke research to clients and partners on geopolitics, macroeconomics, and markets. Marko is the author of Geopolitical Alpha, an investment framework for predicting the future, a book that introduces his constraints-based framework to investors. He has lived in 7 countries and 3 continents. Marko, thank you very much for joining us. Your book was one of the top books recommended for our clients and investors here. So we are eager to hear your insights. It will be interesting to hear a little bit about your bio. So thank you very much for joining us.
It's such a pleasure, Daniel. Thank you so much. It's great to hear that people wanted to talk about my book, and so I wrote it for investors. It was written for investors that are that I felt and still have a very high conviction view are going to be facing more and more political and geopolitical uncertainty, and not just kind of in the emerging markets where people have tended to be very used or expectant of that kind of risk, but also everywhere else in the developed world and so on. So I wrote the book with the intention to provide investors with a framework for thinking about politics in somewhat of a systematic way. And a framework is not a theory, it's not a method, it's just a starting point. What I felt that when I started writing about politics and geopolitics in the markets, I felt that a lot of investors would throw up their arms and just say, like, I can't deal with this. I'm just going to hire a consultant. I'm going to pay a lot of money, and I'm going to let them tell me what's going to happen. And I think that's just a really bad way to do business. You wouldn't outsource your fiduciary duty to somebody, to a consultant on like valuation. Why would you do it on politics or geopolitics? And so I developed this framework, which basically puts the material constraints, the context, the world we live in, at the center of analysis, and treats the policymaker as sort of an appendage. Politicians, policymakers, they say a lot of things, they have a lot of preferences, but at the end of the day, they are prisoners in the material world that they inhabit. So basically, the policymaker preferences are both optional and subject to constraints. The material constraints are neither subject to preferences nor optional. And that's why we as investors should just start in the material reality. Obviously, it doesn't work all the time. Sometimes politicians have a mind of their own. They don't care about risks. They don't care about downside. They ignore constraints. But when that happens, more often than not, you may have gotten the first forecast wrong, but you know what the second one is going to be. You know where the pain is going to be and what the consequences of that are going to be. Now, I started my career in political science, so I have like more degrees in political science than any person should have. It's all kind of useless in many ways, but it has helped me. I have a lot of empirical, knowledge about politics and geopolitics in the world. So in some way, it was useful. And then after academia, I worked in the political risk industry. I worked at Stratfor, and it was extremely frustrating working at Stratfor. Because I think political risk industry is full of, people who are always right, like always right. They're never wrong. I was really frustrated by that. I always wanted to have an objective way to test whether I'm right or wrong, because I'm extremely competitive as a human being. And that's why I love finance. You can say whatever you want, but at the end of the day, your recommendation either went up or went down. And I really enjoy that. I think that's awesome. So I was very lucky when I was recruited by BCA Research, which is the world's largest and oldest independent research firm based in Montreal. So I was 29 years old when they basically approached me and they said, hey, can you build out a political analysis kind of unit that will do politics and geopolitics, but will give buy and sell recommendations on securities, which no one was doing at the time, really anywhere in the world. I'm basically the first person to formalize a research product that does geopolitics, but then says, short BTPs or, long BTPs or whatever the case is. And so that was very exciting. I worked there from 2011 to 2019. And in 2019, I joined the asset management firm Clocktower, where alternative investment management, illiquids, weird stuff like seeding macro hedge funds. My job is to continue to write research for our LPs and for our research clients. And so I enjoy still very much the independence I had at BCA. And it's great to be speaking to some of the largest macro hedge funds in the world and some of the most sophisticated institutional investors on a daily basis. So that's very cool.
No, thank you. That was a nice intro. What are the main pillars of this constraint framework? I think in the book you mentioned 3.1.
Oh, sorry. I mentioned what?
You mentioned 3 of the main pillars. If you can elaborate on those.
Yeah. So where does this constraint framework come from? It didn't come out of thin air. I'm not the first person to think in terms of constraints to human behavior. There's a whole literature about this. Now, it runs counter to Enlightenment. It runs counter to, Kant and Hegel and the idea that we as humans and as individuals are empowered to really be the center of the universe. And so that's an issue. But basically, it comes down to 3 things. First, social psychology research has proven that quite often humans behave to the context rather than they behave based on their views. There's a lot of experiments, and I mentioned one that's really, really cool in the book, but there's a lot of experiments that show that what your values are, what your norms are, what your upbringing is, your race, your education, they all melt away when you're put into a stressful situation and you react based on the context. And so we often make what's called the fundamental attribution error. And that's like a known kind of a fallacy of analysis where we imbue the action of a policymaker based on their preferences. Most often than not, they're just simply reacting to the situation they're in. Again, lots of experiments where humans have been tested to prove this. So that's the first issue. There's actual experimental work in science to prove that humans do not act on their preferences. They act because of the constraints. The second thing is Marxism. But I don't mean Marxism as in like Marko is a communist. I mean Marxism as a social science. Karl Marx, he had a very dramatic departure from philosophy at the time. He basically created what's called a materialistic dialectic. And it stood in opposition to the Hegelian dialectic. Now, Hegel basically says, thesis, antithesis, synthesis. You start off with an idea, and the idea produces a material reality, which again is very Enlightenment. Humans sit around and they say like, oh, you know what we should do? We should end feudalism and we should go to capitalism, and then boom, it happens. And Karl Marx, in Das Kapital, he basically argues that's all wrong. We create ideas, ideologies, and theories to justify basically the means of production that are at our disposal. So during feudalism, what we had at our disposal was basically feudalism. So we created a whole set of religious and theoretical and ideological constructs to justify why we had to keep serfs. Similarly, under capitalism, the means of production improved thanks to technological advancement, and then we created a whole set of ideas and ideologies to justify the kind of division between capital and those who traded labor. And that's a really important social science distinction, and I think it's great because it allows us as investors to really think about the material world first. Forget about norms and morals and Europe and America getting together to go against Russia. All of that can be washed away by a material reality and a change in those constraints. So that's the second pillar. It's the social science application of the materialist dialectic that Karl Marx really invented. And the last thing is intelligence. Intelligence agencies around the world use the method that I use, more or less, with some modification. If you are the American intelligence community, you have a lot of human intelligence, signals intelligence. You have at your disposal so much empirical information that you do not have to think. You can literally tap someone's phone and you can know what they're going to do. Not what their preference is, but what they're going to do. Unfortunately for us as investors, we don't have the resources to do this. Obviously, it's also illegal. So we need to rely on our shortcuts. And the intelligence community has for a long time used on this kind of a constraint framework. When you don't have enough intelligence and signals intelligence, which you have to rely on, is this idea that policymakers will choose the political path of least resistance based on the matrix around it. So anyways, over the course of my career in political risk and in BCA Research, I basically tinkered with this framework. And in the book, I detail what kind of constraints act on policymakers in an investment relevant way. And obviously, there's economic, there's political, there's financial, there's legal, there's geopolitical, there's military. There's a lot of different constraints. They all matter differently in a different situation. It's not an engineering framework. You cannot get better at it by learning it. You just have to kind of know. All you have to take from my view is that policymakers don't actually make decisions. They're forced into decisions. And you can forecast where they're forced to go by the material reality around them.
So hi, Marco. Tony Volpon here. Let me just say I really enjoy your book, and I totally agree that I think, Karl Marx in many ways was like a trailblazer in sort of understanding the superstructure. I think you're talking about the superstructure kind of model of reality. So let's get to like an example, and you talk a little bit about your book about this. And I want to talk a little bit about Russia and what's going on in the Ukraine. So, I think a lot of people, certainly when I was looking kind of the Russia-Ukraine standoff before the actual invasion happened, a lot of people were thinking that Putin would not invade exactly because of the very high economic and political costs to Russia of an invasion. And so I think a lot of people got that forecast wrong. So I'd love to hear how you were thinking about that question before the invasion actually happened, and now that it's happened, a lot of people sort of say, well, Putin has this sort of, this idea that he wants to reestablish the imperial system in Russia's near abroad. And so people now are sort of appealing exactly to preferences and ideology. So I'd love to know, how you're thinking about these questions given your framework.
So ahead of the invasion, I pegged it as a very difficult call. So I was in neither camp. I said it was 50-50, and I said it for the right reasons. Not because of economic costs to Russia. Russia is an energy exporter. Energy exporters get to do really stupid stuff. It's tough to embargo energy. So to me, it was really the right reasons. I expected Russia to lose the military invasion, to be honest with you. So to me, the material constraints to conflict are Russian military incompetence, not recent, by the way, historic Russian military competence. Russia is a country who we in the West have this view of having been an incredible, contributor to World War II. True. But that's because it was attacked. Throughout Russian history, when it's on offense, it fails and then has a coup or a revolution. This is literally the history of Russia. So that's the one thing. The second thing is invading a country like Ukraine is insane. It is 3 times the size of Iraq. It has a population double the size of Iraq. And unlike Iraq, which is 80% was against Saddam Hussein. So when Americans attacked Iraq in 2003, 2004, 80% of the country was basically on their side. I mean, don't get me wrong, it turned sour very quickly. We all know how that went. But, Saddam Hussein was a Sunni leader. Sunnis were 20% minority of Iraq. In Ukraine, very small proportion of the population post 2014 was pro-Russian, whether they were Russian speaking or not. And then finally, the Russians basically decided to do an extremely difficult military operation with an economy the size of Texas. Sorry, smaller than the size of Texas. So America struggled in Iraq with an economy 17 times larger than that of Russia, with a military far more sophisticated, far better trained than Russia. And so, so ahead of the invasion, I basically said, look, I'm concerned that they're going to do it in a limited fashion. But my high conviction view is that they're going to fail if they do it. And then, of course, they did it. Russia invaded. And by March 25th, they basically accepted defeat, which is ironic because on March 25th, the defense ministry of Russia announced victory, which was awesome. You know, March 24th, they had a large swaths of northern Ukraine conquered. And then on March 25th, they said, like, hey, we demilitarized Ukraine so we can withdraw. And it was funny to me because I don't know how many of you follow European football, but it was like PSG basically saying that winning the French league title was a success. You know, like, oh, we weren't going for Champions League. No. What, you guys thought we were? No, we're happy with just beating Lyon and Bordeaux. So the point of all this is that what investors have to realize is that policymakers will not always abide by constraints. And we're increasingly in a world of charismatic authority, as Max Weber talked about. Like, we're moving away from this legal authoritarian to more charismatic politicians, whether it's, Donald Trump, whether it's Orban, and so on, who are going to constantly think that they can overcome constraints. And so just because Putin misjudged his constraints doesn't make him irrational. And it almost doesn't matter if he's irrational or not, because even an insane person will be held back by material constraints. And so what I've noticed, Tony, and your question is actually posed very, very correctly, I think. You're saying people are now doubling down on this idea. Well, if he misjudged this once, he must be tripling down on an insane preference. And that's where you make the most money in markets. You make the most money in the markets when your framework is wrong in an initial salvo, and then policymakers get slapped by the wall of material reality, and then they have to adjust their behavior. So I think right now, the market is massively overpricing geopolitical premium on oil prices with the expectation that this war is going to last forever. And when I suggest that I think Putin and Russia could declare victory again in the next couple of weeks, and the war could actually be over, people look at me like I have three heads.
But well, I mean, just to follow up a little bit on that in terms of what you think is going to happen from here. I think kind of the consensus view, not necessarily the one that I share, but consensus view seems to be that unless Ukraine is willing to give up territory to the Russians, they're not going to stop fighting. The Ukrainians are not going to stop fighting. They're not going to accept, to give part of their eastern territory to the Russians. So the Putin may say, I'd love to get this done and over with. I'll take what I've got and kind of go home. The problem is that the Ukrainians are not going to do it. And with the Western powers just sending them, it seems to be limitless amount of weapons, they'll keep fighting. And that's why the war will go on. So let's change this around. What are the constraints on the Ukrainians that will make them stop?
Javelin missiles are not offensive weapons. I mean, that's what I'll say. Ukraine has not demonstrated any real capability to seize territory from the Russians. It's usually been Russians withdrawing because they fail to hold territory. So you're right, Tony. The Ukrainians will not give up, and I kind of don't care. I think what's going to happen is we're going to have a frozen conflict. Russians are really, really bad at fighting a war, like really. And they have been for decades. And again, everybody just ignored recent history and their inability to win anything anywhere. But holding territory with artillery and entrenched positions is relatively easy. And so Ukrainian military would have a really, really high hurdle without air superiority, by the way, to attack and attack entrenched Russian positions. So basically, what we're talking about here is, I don't expect Ukraine to admit defeat. I don't expect them at any point to cede territory, just like they never ceded annexation of Crimea in 2014, and yet the conflict was frozen. I think what can happen here is a Korean War resolution. Korean War never ended, like officially. It's been going on for 69 years. But there's a line of control, there's constant fighting. And across that line of control, But what matters for the markets, and this is important, and this is where we as investors have to stop being human beings. We have to not have a normative moral view of the situation. What matters for the markets is that once Kiev is not being shelled, once the shelling is being done in some eastern part of Ukraine that most people can't find on a map, the images of Ukrainian civilians and refugees go from page 1 of the newspaper to page 6 and 7. And at that point, the unity of the transatlantic alliance and the implementation of the oil embargo and of the sanctions will begin to fray. And so I think that the geopolitical risk premium associated with oil prices at the moment, and this kind of like mythical 1.5 million barrels that everybody thinks we're going to lose from global supply, which I'm not sure how people get that figure, but we can discuss that. That's where it can dissipate. And that can create the geopolitical alpha opportunity, where market is still thinking of this as a significant macro event, and it actually dissipates in its market impact.
Thanks.
No, and now, yes, it leads us to so many follow-up interesting questions. One thing that you mentioned in the book was that like pandemic accelerated some things that already began in 2000s, like the geopolitical multipolarity and deglobalization. And just curious how you see that Russia tried to make ties with China. How do you see this relationship, Russia, China, US? I understand in the book that you're not like on the camp of this bipolar US-China war. There's more to come. So trying to get your sense about these relationships.
I mean, I think that Ukraine could change that. And I think there's a really very, very dangerous situation for China. You've seen Xi Jinping's rhetoric has been really pro-Russian, like very, very clear. Recently, there was another statement where, he basically said, look, we're aligned with Russia. The issue is that when you look at the specifics, China has been reticent about increasing purchases of Russian oil. It's frozen military exports to Russia, including drones, which Russia really needs. Russia really needs help right now with military exports, and China's not giving it, which is a weird way to treat its ally. The West is throwing a kitchen sink at Ukraine. It's giving Ukraine everything. The Chinese are not giving Russians anything. And that's an indication to me that China understands that it's a multipolar world, and it understands that the relationship it needs to cultivate is with Europe. The last thing that China wants is to push Europe to the West, to the US. And so it's being very kind of rhetorically supportive of Russia, but actually quite vacuous. And look, I think that the multipolar world will stay, because I don't think the West will be united on Ukraine. You're already seeing Europeans go back to their kind of previous position, which is trying to push Ukraine to negotiate with Russia. I mean, remember, France and Germany negotiated the Minsk Accord that ended the 2014-15 conflict, and it was very onerous for Ukraine. And it was the US that came in later and said, you don't have to abide by this deal. It's a bad deal. We'll get you a better deal. And so I think 6 months from now, Europeans are going to take a cold shower and realize that US way of dealing with this is not in Europe's interest. American natural gas prices are not up massively. They're going to go up. I mean, I'm bullish, but Europe is the one that's suffering from natural gas increases. And how many refugees has America taken over the last several months? Like 1,000. There's 5 million Ukrainians in Europe. So at some point, Europeans are going to realize that they need to negotiate and solve this themselves, and that America is actually not helping the process. America has much higher risk tolerance. And so it's going to always tell the Ukrainians, don't deal with the Russians. We'll get you a better deal with more weapons and more war. So that's where multipolarity gets, I think, in my view, entrenched by the conflict. And this is a really important, it's not an academic debate. This is a really important debate. First of all, if you're a long-term institutional investor in Canada or Australia or the US, you have to know if you're in a bipolar or multipolar world. A bipolar world means you cannot invest in China, Russia, and other parts of that sphere. You have to allocate 0%. So that's the first issue. The second is, if you're sitting in Brazil, or if you're sitting in emerging markets, you have to understand, do I need to pick sides? In a bipolar world, you kind of do have to pick sides. But in a multipolar world, it's actually really beneficial for countries like Brazil, like India, to be geopolitically promiscuous. You know, are China and the US powerful enough to enforce a strict alliance? If the answer is yes, then hey, you got to pick sides. But if the answer is no, then there's a wealth of opportunity for emerging markets to actually really play this environment very intelligently. And I think India is proving this. I think India has proven exactly what emerging market economies will and should do. That's why I'm very bullish Latin America. That's why I'm bullish emerging markets, because I think in a multipolar world, they don't have to follow orders. They can ask for the highest bid. You know, you want me to do something for you? Hey, you know what I need? I need some low-cost financing for a new port. China, US, Europe, what's the highest bid? You know, that's the world of multipolarity. Cold War was like, hey, you know, don't talk to Russia. Don't talk to the Soviet Union, or else we show up with a gunboat outside of the capital. That's not the world we're in. And I think more and more emerging market economies and leaders are realizing that they can actually be quite promiscuous, unashamedly so. I mean, starting with India, which I think has played the Russia situation from a Machiavellian perspective really brilliantly.
So, Marko, you have a really interesting thesis in your book. You talk about a shift, a sort of populist leftist shift to something you call the Buenos Aires consensus, which will be replacing the much better known Washington consensus. And you say this could last for an entire decade. And you talk a little bit about that, because I think it's an interesting thesis. And then I'd like to ask you, you know, it seems, I think, the Biden administration is kind of moving in that direction with those big packages and the Green New Deal and all the spending. And I think there was a lot of flirtation with kind of modern monetary theory. You know, some of its leading exponents were actually, you know, consultants to people, to Democrats in Congress. But remembering that Argentina has always had very high and persistent inflation, and now the US and the rest of the world's having very high persistent inflation, and a lot of that is being blamed on this huge, you know, kind of fiscal spending that came out of the consensus. So my question to you is, isn't inflation sort of the limiting material constraint to the Buenos Aires consensus? And will, in fact, this current bout of extreme inflation kill this consensus even before it's taken hold?
Let's wait until the recession, Tony. Then we can discuss it. You know, I find it hilarious. Listen, we're in the investment community, right? We're all savers. We're all pretty much members of the 1% of our respective countries, or 10%. And so we have this view like inflation is bad, you know, because we have savings that are going to get eroded by inflation. But here's the issue. What's worse, having to dip into your savings or your revolving credit to pay for $7 gas at a gas station in California, or not having a job and thus being unable to pay $3 gas?
But you yourself talk about the medium voters being the guy who's most important in the political process. And all the polling data that we can get, including the crash in the Biden administration popularity rating, seems to point to inflation as being extremely unpopular amongst all, you know, all classes, whether you're wealthy or not. You just don't like it.
Again, let's wait until a recession. I can guarantee you this, as a political risk guy, and as a person who's lived through a hyperinflation, and not Brazilian bullshit hyperinflation. I'm talking real hyperinflation.
We had some bad years here.
No. I lived through the second largest hyperinflation in human history in Serbia. Second largest. And I'll tell you this. There's no way that people want a recession over 8% CPI. Like, I mean, no, zero chance. So when the Fed, a bunch of unelected technocrats who have never had a real job, you know, who have more PhDs than years working in a real private sector, when they cause a recession, the Buenos Aires consensus is back.
Okay.
And so that would be my answer. Now, there's two ways to interpret this. One, they'll cause a recession, and like, what happens if there's a recession in the United States of America ahead of the 2024 election? I mean, like, the person winning that election will be a populist. I think we all agree on that. It's not going to be Paul Ryan coming back to give us some, exactly. So that's my point. That's why we're still in the Buenos Aires consensus. The second is the Buenos Aires consensus actually is still here, and actually is going to create a constraint. on the Fed. So they're right now beating their chest and talking about inflation. But the moment the hashtag inflation hysteria, which you're correct, is showing up in the polls, the moment it becomes a recession growth hysteria, they're going to back off and make an excuse for why they're backing off. Now, I have a relatively sanguine view on oil prices, as you can probably tell from my Ukraine view. So I think what happens probably by the end of the year, CPI is at 5 or 6%. Given the headline inflation, peaking, core has already peaked. And then what happens is the growth starts, ISM is in high 40s, maybe low 50s. My expectation is that at that point, the Fed will say something like, we are asymptotically approaching our target. And therefore, we don't have to do 175 basis points. So they're not going to back off. They're not going to do QE. They're not going to do cuts. Just we go back to 25 basis points. And that will be evidence of the Buenos Aires consensus. Furthermore, I would argue, look, they were buying bonds in March with CPI at like 7-8%. Like the fact that they just raised rates 75 basis points, they're still massively behind the curve. Nominal GDP growth relative to 3-month treasury yield, however you want to show it, we're in this massive, and that's why I think that I basically don't think that they have the guts to pursue the policy that right now they're flagging. Now, inflation is an important part of this. I think that Buenos Aires consensus, when I write about that, it's very important to focus on the fact that I don't say it's a universal policy. Like Brazilian central bank has been the most orthodox bank in the world. And you have, Macron won the election in France. Granted, he lost the legislative vote to leftists and Green Party. But my point is that Buenos Aires consensus is specifically happening in the US. It's the US that's abandoning the tenets of the Ronald Reagan, Margaret Thatcher revolution. And so inflationary outcomes in the US will continue to surprise to the upside relative to the rest of the world. Now, Europe has inflation, but it's mostly just energy. Yes. Now, wages will pick up given that. You see what's happening in Germany with labor negotiations. But US is really the one country where inflation is heterogeneous, it's multifactored, and that is a consequence of completely insane stimulus measures post-COVID, which in percent of GDP terms cannot be found anywhere else. So it's the median voter in the US that's actually moved the most to the left in relative terms. And I think that most investors have still not come to terms with this. If they had, the US dollar would not be where it is right now.
You touched some interesting points. Just curious on your views on the probability of recession. It looks like from the base and the high nominal growth, it may be further away than 12 months that everybody says. So a little bit on your view on that topic, especially in the US.
Daniel, I would agree with that. I think we are further away than 12 months, especially if my view ends up being correct, that the Fed takes just 5% CPI as a victory. And I think they will. I think when they see the growth downturn, I think they will declare victory and then just kind of slowly let inflation come down. By the way, what's funny to me about all this...
A bit like the Russians, right?
Yeah, I guess so. It's also kind of look, last cycle, how many Fed officials or PhDs in economics told us, oh my goodness, if we only could have 3 to 4% inflation for a couple of years, if we get 5% CPI, we have that. Why are we going to freak out about it? So what I would say is, I think if the Fed does back off, if it's not trying to channel Paul Volcker, and if it takes it a little bit easier on the hawkish policy, then I do think that you could have more than 12 months from a recession. And one of the reasons for that is that savings, you're still talking 2.4 trillion of excess savings that showed up out of nowhere. We have data that shows that that households are dipping into savings. And we have data that shows that private credit is starting to pick up. In other words, households are leveraging themselves up for the first time in a decade. Don't forget, US households were on vacation for a decade. They didn't participate in the global economy almost at all. We had deleverage of the private sector in the US during the secular stagnation years. So debt levels are low. Delinquency rates are the lowest on record. And so people are dipping into revolving credit to deal with higher prices. If those prices come down from 8 to 5, 4% over the next 12 months, that makes it even more easier for them to deal with this. So I think growth slowdown is for sure. I think the handoff from goods to services scares me. I think that's going to be difficult. But I do think that there's a scenario where we don't have a recession. That would be my base case view. But I know it's a very difficult call. So, I'm not sure my view is that, relevant.
And curious, just quick follow up. You mentioned that from the geopolitical standpoint, oil may be like overbought, but at the same time, you make a call that natural gas in US is like is prone to go up. Just trying to understand your view, like on the commodity side.
So I think natural gas in the US is undervalued relative to the rest of the world because it's captive to a domestic market. Remember, natural gas is not a global market. And so, but as it becomes a more global market, thanks to LNG and LNG exports, US natural gas should be in a secular bull market, provided that Americans don't do something like ban exports because of rising prices, which I don't think they will do. Oil, however, I'm bullish on commodities in the very long term for a number of different reasons that you guys already know, like Jeff Curry's green transition, all this stuff. I agree with that. It's just that right now in this pocket of the next 3 to 4 months, demand, I think, is not as bullish as people think, especially because of China. Chinese imports and oil prices are correlated 1-to-1. Chinese imports have been coming down, oil prices have held. And I think that divergence between the two is basically the geopolitical risk premium. So then you have to have a view of the conflict in Ukraine, and most importantly, the EU embargo. And I just don't see how the EU embargo impacts oil prices. You have 6-month implementation period. During those 6 months, Russians will find non-European, non-Western insurance providers to insure their cargoes. And there is an oversupply of tankers right now with freight rates at some of the lowest levels in decades. So the fact that they're going to have to get more tankers to take a very long trip around Africa to supply Asian markets, you go from 2 weeks to 70 weeks. That sucks. It's going to cost more, but freight rates are low, and Russians are just going to dip into their profit margins to pay for that. Meanwhile, Europe will buy more oil from the Atlantic basin that usually goes to Asia through the Panama Canal. And so all we're doing is reshuffling the chairs, in the auditorium. Now, I'm being hyperbolic. I'm being very top down. We're having just a debate here. I just think that this idea that we're going to lose 1.5 million from Russia, I don't see it. And so that's why I think that the geopolitical risk premium in oil prices might be overstated. And we could be down to pre-war levels, which is not a huge, fall in oil prices. It's like 95, 100. If that happens, the Fed's job gets easier. The CPI numbers start coming down. Jay Powell said on June 15th, we're targeting headline inflation, headline CPI. Headline CPI peaks, it starts coming down. Then you cannot have ISM falling from mid-50s to high 49s without an impact on CPI either. The two are also correlated. So you have this slowdown in Chinese growth, slowdown in US growth, geopolitical risk premium dissipating from oil prices, which will then give the Fed an excuse to kind of back off a little bit and go back to 25 basis points at a more kind of a regular interval. So that is a scenario that I can see building up over the next 3 months.
No, excellent, very coherent. Let's talk a little bit about China. So in your book, you actually speak fairly highly of Jiang Zemin's 3 represents as a way that I guess the Chinese Communist Party was shaping policy to suit its medium voter, which I guess was the growing Chinese middle class. With Xi Jinping, again, the consensus view is that he's also this very highly ideological guy who's been, he imposes very unpopular zero COVID policy, deleveraging of the real estate sector. So how do you understand Xi in China today, again, given your framework?
I think that Xi Jinping has done almost everything over the last 10 years, maybe up to until this year, with the interest of the median voter in mind. So 2012 to 2017, he worked hard to get the political capital to do the painful stuff. So 2012 to 2017, that 5-year period was really colored by the anti-corruption and anti-pollution pushes, which were extremely popular with the growing middle class in China. And so then he built up the political capital thanks to those policies to then pursue deleveraging from 2017 onwards. And the leveraging is not an unpopular view in China. The middle classes in China are concerned that the SOE-led growth is unsustainable. And they've been wanting the government to kind of shift that towards the private sector, more organic demand. The problem is that it's kind of too late. The private sector in China is just massively leveraged because from 2012 to 2017, they did 5-year orgy of credit because the US consumer, the private sector deleveraged, public sector did austerity, did not leverage to offset the private, and China was left alone looking around saying like, what the hell are you guys doing in Europe and the US? And so they had to pick up the slack with domestic demand. That's now put them in a corner that's very painful, almost no matter what Xi Jinping does. The private sector is just massively leveraged. Household debt in China as percent of disposable income is actually higher than it is in the US. And so they're pushing on a string. They're trying to cut interest rates. They're trying to tell banks to lend, and it's hilarious. Every time TSF data comes out, it's like banks lending to each other, interbank lending rate going to zero, but they're not lending to private sector. It's exactly like US going to 2009. And I think a lot of us in the investment community were like, oh, it's zero COVID, zero COVID. No, I have a much more bearish view. I don't think it's just zero COVID. I think it's like a real balance sheet recession problem in China. I think Xi Jinping on zero COVID is being ideological. I think he's trying to save face. Look, it worked in 2020, 2021. He promoted it as like, I'm a genius, Americans are idiots, for good reason. I mean, it did work. And so now it's really difficult for him to pivot. So what I think is going to happen is I think that they're going to try to get to November, limp to November, and then just do a 180 degree on a number of different things. 180 degree on zero COVID, 180 degree on private sector leverage. And I think they're going to have to pull the old school investment-led growth lever. They're going to have to break glass and pull it. But that means more pain, more downside, and more deflationary export. China will export deflation, not inflation, to the rest of the world until they panic and say, we can't have the French Revolution. We got to pull the infrastructure lever. But that's only going to happen after the election. That's the difference between China and the rest of the world. The rest of the world, you want to do stimulus before the election so you win it. In China, Xi Jinping has hung his hat on deleveraging. I don't think he can move away from that until he secures another term. And then I think he will, given the self-preservation and just the fact that, China will face a lot of problems politically if they don't stimulate at some point and put a bottom on growth.
Let me cross the world now and go to Latin America. You mentioned that you're bullish in emerging markets. So my question is, does it include Latin America?
Yes.
And in terms,
yes.
No, and that matter, we think valuations in Brazil are very cheap, very attractive at this point in the cycle. Is pricing like kind of very bear scenario, so we think is an attractive opportunity. But one thing, you discuss in the book, like Argentina, that market loved Macri, was the reformist guy, but he lost the election last time. Then we had in Brazil. Try to get how is your assessment of the Brazil outcome, in the sense that I would say the median voter in the past election was all about corruption, was about that. What's your view of Brazil right now in terms of the election outcome, in terms of what the median voter wants, and in terms of investment attractiveness?
I almost don't really care. And this is something I learned. I'm a political analyst in finance, so I constantly have to have a view. And I've gotten Brazil wrong all the time. I would get the politics right, but the market's wrong. And so then I would sit there and I would say to myself, what is going on here? And what's going on is that foreign investors just really don't care. They just don't. They say they do, but they don't. It's all about terms of trade. It's all about the commodity price. It's all about China putting bottom in growth. And it's all about the US dollar. And I think that over the next 6 months, I think that the last pillar of the dollar everything bull market will fall. The risk asset pillar of the dollar everything bull market was NASDAQ. Done. Dead. The risk off pillar of the dollar everything bull market was bonds, right? Risk parity. You buy some NASDAQ, you offset with bonds. Dead. The final pillar is the actual dollar itself. And I think it's going to come down as investors in Switzerland, the S&B, Norges Bank, Future Fund of Australia, ADIA realize that Americans are burning through their money through populist policies. At some point, that's going to happen. Probably when China puts in the bottom on the growth, US loses growth differential advantage. I think at that point, investors are going to say, like, why am I investing in US assets when inflation is outperforming in the US? And that creates an incredible set of tailwinds for Brazil, for Latin America. You've got a commodity super cycle. You've got a dollar bear market. You have China putting in bottom on global growth, on high beta growth, like Europe, Japan, emerging markets. Terms of trade are going to look great. And I think that you can, like I'm telling our clients or institutional investor clients, I'm telling my partners here at Clocktower, I'm saying, like, you need to get as much Latin America as you want, as you can. And then, of course, the counter to this is like, oh, look at Chilean elections, look at Peruvian elections, look at Colombian elections, look at Brazilian elections. And my answer to this is, my experience from Latin America is this. If commodities are up, dollars down, China's okay, Karl Marx could rise from the dead, run for the president of Brazil, and you should buy Brazilian assets. You know, that's just the macro context that will matter more than anything else. And by the way, Peru and Chile have shown this. Peru and Chile have had non-market friendly outcomes, but there's still constraints to how far leftist leaders can take them. Congress, legislatures tend to be very split. Same will be the case in Colombia. And I think that Brazil would basically be the same. Yes. And so I'm not worried about it at all. And I'm very bullish. We've actually, we started a fintech. So we have many weird investments, liquid investments here at Clocktower. One of them is a venture endeavor in fintech. And in 2019 and 20, I was so convinced that we would have, 2020, I was so convinced of a commodity bull market. And I was so convinced of inflation and the fact that emerging markets are going to win the next decade. And basically, I convinced our partners to start a fintech fund in Latin America. And I got to tell you, we've never raised that much money that fast. You know, like it went like this. And I think any way that you can invest in Latin America, I would. And it's funny, you talk to pension funds that, you know, a lot of our LPs here at Clocktower are institutional investors. And so I service them with my research. And a lot of them look at me like I have three heads. And, you know, one of them, huge multi-$100 billion fund, told me, but Marko, we're closing our office in Sao Paulo. Like, what are you talking about? You're like, this is an insane view. And I was like, well, when did you open that office? And the answer was 2011. And I was like, okay, well then,
top of the cycle.
You're basically the cover of The Economist, you know, so, you know, you have fun with that, but I think that Latin America will do very well.
See you in 10 years when they reopen the office.
Yes, it does. Look, I mean, there's other reasons too. Like, we're on the private side, we're seeing a lot of entrepreneurs come back from the US, open up new firms. You have a lot of people who are starting businesses, applying business innovation that worked in the US to Latin America. I think a lot of investors thought that the TAM, the TAM of like fintech or SaaS businesses was global. It's much less global than we think. There's more regionalization, even in software businesses. So even in tech, there's a lot of innovation happening locally, India, Latin America. The other thing that I think is really interesting for Brazil is if this European plan to impose a green tax at the border happens. You know, basically what's going to happen is if you produce most of your goods and manufactured products and exports using coal, the Europeans are going to have to tax you in order to make their carbon credit thing work. Well, guess who wins then? Brazil. Brazil has, out of major countries in the world, like we're not counting Norway, you know, which has 4 million people, Brazil actually produces majority of its electricity through hydropower and other things. And so, like, manufacturing could move to Brazil to arbitrage these policies over the next decade. So I'm fairly bullish on Latin America, and I think that a lot of investors are just looking at the last decade and thinking that Latin America is a mess, and they're overstating the politics.
I totally agree. I mean, that this is a view we've made. We think we're kind of in a commodity super cycle. And I totally agree. I mean, I remember 2002 when Lula got elected, and we had a major financial crisis, and everybody thought the world was going to fall apart. And in fact, it was the beginning of a multi-year bull market, very much driven by the entry of China in the global economy. And you're right, 2010, 2011 is when things turned around, and the correlation between Brazilian GDP in terms of trade is extremely, extremely high. So I totally agree with that.
You know what's funny about this? Everyone's pulling their hair out about deglobalization, and and we're not deglobalizing fully. There's still like globalization. But my point is, you just said a great point. China was entering the global world. We were putting China in the middle. Well, now that we're going to move China a little bit off center, that's going to cost money too, because you got to build manufacturing capacity somewhere else. Brazil wins. Like, in other words, Brazil and Latin America are ignorant, are aloof of who's going where. As long as there's capex, as long as there's capex in the world, and as long as we're in a capex-driven cycle, it's going to require materials, commodities, metals, iron, energy, and so on. And so, I really think that this is something that people are missing. The other thing is geopolitical aspect of this. I was in Panama recently. I was invited by there was a big event in Panama. Bloomberg organized a really interesting Latin American focused event. And, the Panamanian government was in the front row, and everyone on the panel was very America-centric. You had the president of the Inter-American Bank of Development, you had some professors, and their message to Latin America was you need to choose to go with the US. Okay, guys, hey, China's mean. China doesn't have governance. This is so important. And I'm sitting there and I'm like, look, what Latin America should do is be as promiscuous as it can on the geopolitical front. And all I can tell you is that everyone in that first front row, all the policymakers were like, oh yeah, don't worry about it. And the US Embassy staff was in the fourth row. And it was funny because they had these probably Trump surplus masks with giant American flags. And so I was like, hey, there's the Americans in the front. And they were like, yeah, that's us, And my point was look, in the 60s and the 70s, they would have been in the front row.
Yeah.
The president of Panama would have been in the second row. And we're not in that Cold War world anymore. It's a much more messier world. And I think countries like Brazil are going to learn from countries like India. They're going to learn how to play this. There's absolutely no need to sign anything, highest bidder gets what we produce. So let's see who's going to give us the highest price. That's the world we're in. And I think that's a real geopolitical sweet spot for emerging markets.
That's great. I think we're running out of time, right, Daniel?
Yes, no, this discussion was very rich. Marko, I want to open the space for your final remarks on behalf of WHG. Thank you very much.
Well, I just want to thank you. I'm always flattered. As I said, I wrote the book for investors, not for myself. I want to empower people so that they don't have to pay high-priced consultants. If we as investors think that we can do valuation analysis on our own, if we think we can do momentum, technical analysis, bottom-up, if we can do all of that, we can also do political and geopolitical analysis as well. That's all I'm saying. There's a systematic way to do it. And my book tries to make a case for that. When we go to work, we take kind of a toolbox. And my point is, let's put politics into the toolbox as well. And I think that, Brazilian investors are going to know this inherently because it's not like politics ever ceased to matter in emerging markets. So maybe it will be more appealing to your community. But I know that in the West, a lot of people have just lost their ability, their touch, to think about politics in investment relevant ways. But we're all going to have to become geopolitical strategists over the next decade.
That's amazing.
Thank you very much. Have a good evening, everybody. Thank you.
Real pleasure. Thank you, guys. I'm very humbled. Thank you.
Take care.
Bye-bye.
Bye.